Yeah, good evening, everyone. It's a real privilege to have the opportunity to talk here tonight. So just a bit of background about myself. My name is Clive Butkow. I'm the CEO of Kalon Venture Partners. We're a Joburg-based digital disruptive tech, very innovative venture capital company. In my previous life, I'm a computer science background. I joined Accenture, always been an entrepreneur. I ran Accenture's technology business. I then became the CEO for the last 6 years of my career, and I retired about 8 years ago, back at the end of 2012. Failed retirement, and I started following my real passion, which was building businesses, working with people, turning good to great, and helping people turn small businesses into huge businesses. So I've been involved on both sides of the table, as Paula was saying, as the entrepreneur raising capital, as the venture capitalist deploying capital. So I've been there, and tonight I'm going to talk about those experiences. And really, it's not about, what I'd like to do tonight is not about what you're going to learn in a textbook. It's what's come from my heart, what I've seen out there and all the failures that I've made to actually be able to have this conversation about what I think is the playbook that takes you to success. But before I start, I just want to just go back. When Fred asked me initially to come talk here tonight, he said to me, but Clive, I can't pay you anything. So I said, well, that's fine. This is not a problem. So then he said, oh, that's great, but please still make sure it's still good. So anyway, you're going to get something that's good for nothing tonight. So the title of my talk is the 10 lessons for raising venture capital. Now let me explain to you just quickly where we are. So Kalon Venture Partners is a growth capital investor. A lot of the stuff I'm going to talk about, these 10 lessons, is sort of to mirror what Paula was saying, but maybe I'll use different language to say exactly the same type of thing. And the reason I actually use the 10 lessons, and I like to use this sort of way of doing it, is just in case I suck, that when I get to 6, I haven't got a long way to go till I get to the end. So just bear with me. But this is really from experience, and this is not for everyone, but this is my experience from 30 years in doing this type of thing. And Paula said this as well, but maybe I'm just using a different word. Now, what do we look for when we make an investment? Number 1, number 2, number 3, number 4, and number 5 is the team. We invest in people. We don't invest in ideas. We don't invest in products. We don't invest in technologies. That's the last thing we invest in. Number 1 is the team. A great team with an average product is going to win in the marketplace. An average team with a great product is going to lose. So everything is about the team. And when we talk about team, when we make an investment, we don't like to invest in solo entrepreneurs. So all of you out there that want to raise venture capital, that want to really take your businesses globally and talk about that exit that Paula spoke about, if you are a single entrepreneur or a solo founder, you need to think about that. It's so hard to build a business by yourself. It's like being a single parent. And I always believe, instance, but Clive, I can't get a founder. I say, well, what have you got that someone else doesn't have? You've got equity. You've got equity you can bring in for a founder. So there's at least 2 people that every single company needs. There's got to be the people that can make the stuff, okay? The tech guys, the engineers. I'm talking about a tech business now. So the engineers, and there's got to be the guys that can sell the stuff. Do you all agree with me? You've got to make it, you've got to sell it. Now what we come across quite often is we find great engineers that have started a business, and what do? They build more and more and more and more tech. Why? Because they're comfortable building tech. And the product's never good enough to go out to the marketplace. But they don't actually know how to sell the tech. So if you are a solo founder, give up equity to bring in a very, very strong person. Your team is everything. And I don't mean you as the individual. Your team has got to be better than yourself. You've got to hire better than yourself. Else all you become is a bunch of Russian dolls. You take each Russian doll and you're just a smaller version of yourself. So team, that's what you need to invest in. Okay, my number 2 is bootstrapping before raising capital. Now, everyone, the first thing they want to do, they get an idea, they get a product, they want to go, let me go and raise capital. Now, let me just explain to you guys, capital doesn't validate your business, or it doesn't validate your business model. Customers are the only thing that validate your business model. So raising capital from me is not to go and celebrate, I raised capital from Kalon. There's no celebration. That's when the hard work really starts. What's going to make your business really is bootstrapping it before you actually go and raise capital. And what do you mean by bootstrapping? Do it on the cheap. Go into Amazon Web Services. Go and get customers. Go and focus on getting customers. Get paying customers that you don't have to get investors on board too early. And why is it more important to get customers than investors? Because it's non-dilutive. Customers don't dilute your equity. You've got 100%. You don't lose equity by getting initial customers. And people would say, but Clive, we can't do that. How do we ever get a customer? Because you've never asked. If you've got a great wireframe, or you've got a great prototype, or you've got a great idea, and you can sell your vision, you've got to be able to sell that vision to the customers. They will, and that's I've built lots of our businesses, is actually going and getting customer funding. Customer funding is the best form of funding you can get to start an entrepreneurial business. So it's not about venture funding. Venture funding happens later on in the day. Point number 3 is the burning building. And Paula said this as well. And I use the word, get out the building. And why do I say that? Because in all honesty, someone said to me that today, they said, we were having a discussion with a company that we want to start a $100 million fund. And they said to me, do you invest in AI and machine learning and cryptocurrency and blockchain and blah, 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 blah. And I said, no, I don't invest in technology. I invest in what the technology solves. Okay, so I invest in the bigger the problem, the more money that entrepreneur is going to make. So I like investing. If you look at Africa, Africa's got lots of problems. I.e., there's lots of opportunities for entrepreneurs to solve those problems. That's why there's probably no better place in the world to be right now than on the African continent. We have those opportunities. You guys, the radio school, you guys standing in front of me here are going to be the future of Africa. The future of this continent is going to be in the entrepreneurs, not in the discoveries of the world, not in the Accentures of the world. It's going to be in the hands of the entrepreneurs. So what do I mean by getting out the building? You've got to go out there and speak to your customers. Find out what problems they have. What you need to find is there's 2 types of problems you can have. One is nice to have, one is a need to have. So one is a real problem, which is an aspirin which solves a painkiller. So if you're on your way to work and you've got a real headache, you're going to go back home and you're going to take that aspirin so you can knock out your painkiller. That's the type of problem that you need to solve. The other one is a nice to have, which is a vitamin. So if you're on your way to work and you forget your vitamin, you're not going back home. You're just going to school. You're not going to notice if the vitamins are working or not, but it's not solving a real problem. So you've got to solve real problems, and the only way you can do that is get out the building. Go and speak to your customers. There's 2 fantastic books that have been written on this, The Lean Startup by Eric Ries and Customer Development by Steve Blank. It tells you exactly how to be an entrepreneur and go and start a business. Go and read those 2 books. It will not let you down. I don't know if you all know about the business model opposed to the business plan. A lot of people talk about the business plan. You need a 300-page business plan. Laurent, my CEO at the back there, we've seen 1,200, 1,500 businesses in the last 4 years since we formed Kalon. And in all honesty, we've seen these 60, 70, 80-page business plans, and we don't read them. I don't think the person who created them even read them, in all honesty. Someone else did it for them. They can't never have read that document. It's too long. I mean, it's got the thud factor. You just thud it on the desk and embrace the desk. It's not what we're looking for. What we look for is a business model. So Alex Osterwalder talked about the 9 blocks of the business model canvas. Now for me, when someone comes and has thought through what's your customer relationships, what's your value proposition, what's your customer segments, what's your costs, what's your revenues, and thought about that, so the business plan is far more important. Why do I show a picture of Tesla there? Because Elon Musk has come up with a much better business model than a better car. There's lots of electric cars around the world, but his business model about getting paid up front is business model innovation opposed to product innovation. Everyone thinks you can only innovate on products. You can innovate on your business model. And I love companies that innovate on their business model. So they get subscription revenues every month. They get paid a subscription fee. That's the best type of business you can get. You make money while you sleep. Not you have to sell it like when I was Accenture. You sell it, you do it. You sell it, you do it. You sell it, you do it. It's hard. It's hard building a business like that. So look at not just your business plan, but look at the business model. And again, there's a fantastic book that can educate about this. Number 5 is the 50% rule. Now, you have to get customers. If you want to come to me and speak to me about having money, you need logos. You need Standard Bank and Discovery and et cetera, logos that you're doing current work with. Traction trumps everything. You need to get customers. And too many people, like the engineers, and no disrespect to you engineers in the room tonight, you're building your tech and you're not getting customers. So 50% of your time has got to be spent on hiring and on your tech development, but 50% on sales and marketing, getting out there and getting customers and solving their problems. So you've got to find that balance between customer development and product development. And I'll be honest with you, from being involved in business for 30 years now, I've never seen a business fail due to product development. I've seen many, many businesses fail due to the lack of customer development. So you need to solve the customer problem, then you will grow a great business. Don't build a great product and say, I build it and they will come. That's in the movies. That's not in real life. So don't take your skill set and say, I'm an AI expert, let me just build an AI solution. Then go and look for the problem that you're trying to solve. Doesn't work that way. You're building the business the wrong way around. So build the customer development before product development. Number 6, and probably my most important one of the lot, is focus. What I see in so many entrepreneurs, why we don't invest in entrepreneurs. We've seen, say, 1,500 businesses, but they're not bad businesses. You know, people say they're lifestyle businesses. I don't judge what. If you want to have a lifestyle business, fantastic. If you want to have a surfing shop and you go and teach surfing lessons, it's fine. If that's what you want, no problem. There's no right and wrong of what you want. But if you want the business that Paul was talking about, the exit, that you can sell to a company and make a retirement and you can retire at a young age, that's a different type of business. But what you need is, most importantly, is focus. And focus is actually narrowing down the number of things and opportunities that you have to as few as you've got. So it's actually learning how to say no opposed to learning how to say yes. Now, when we see these 1,500 entrepreneurs and they've got 2 clients in South Africa and then they've got 1 client, they're trying to get 1 client in Singapore and 1 client in Europe and 1 client in America, it's the biggest turn-off to me. Because why are they running around the world when we've got a 55 million people population here, a GDP of $400 billion? Why are we running around the world where it's so hard? Because you can't build your business here. Because you're failing to build your business here, that you're running offshore to go and build a business there. So, focus, focus, focus. Rather, less is more. More is not more. So if you've got 10 things you're trying to start a business with, narrow it down to 1 or 2. Solve 1 huge problem, then solve 10 mediocre problems. So what I'm really saying is, rather, don't go horizontally go a mile wide and an inch deep. Rather go an inch wide and a mile deep. So you focus 1 problem. What's your value proposition? That 1 problem that you're going to solve will be better than anyone else in the market. You're going to be 10 times better than anyone else in the market. And I'll tell you something, I'm writing you out $1 million check. Because that's what I want to see. You're getting traction, you're solving 1 problem. One of our companies is called FinChatBot. It's an artificial intelligence conversational AI product. Now, everyone's building AI products. But what's different to our product? We only focus on financial services. There are so many generalist bots out there and AI stuff, but we focus on financial services. We've got 17 of the top 20 financial services clients in South Africa. We don't have Discovery, so I must come and chat to you. Actually, I think we do. But anyway, that's besides the point. So that's the focus, and I could go on for focus the whole night, but I'm actually going to stop there because I'm going to run out of time. So number 7, and Paul used exactly the same thing, was know your numbers. You know, when I talk about know your numbers, I'm going to just speak a little bit differently what Paulo said. So when someone's building a software as a service business, a tech business, a subscription-based business, I want to know, yes, they got the income statement, their balance sheet, and their cash flow statement, and what Paulo said, I'm not going to repeat that. But I want to know what's your cost of customer acquisition. What does it cost you to acquire a customer? So if it costs you 50 Rand, then what's your lifetime value? That's the numbers that I want to know. What's your churn rate of your business? If you've got a business that's accounting software, but you're churning, I saw a business a few weeks ago that was churning roughly about 4-5% per month. So I said to them, do you understand that every 2 years you have 100% new customers? You cannot grow a business like that. And I couldn't actually understand that the churn rate and the cost of acquisition and the lifetime value was the 3 numbers that I want to see. And when I ask an entrepreneur those numbers and they can't answer it, I lose interest. Because they clearly don't understand that knowing your numbers is how you actually grow a business. So if I put a Rand in, I want to get 150 back. It's simple. Anyone can understand that. But if you put a Rand in and you're getting 30 cents back, it's a problem. Uber, what's the problem with Uber? They put $1 in, they get 70 cents back. That's why their share price has gone to nothing, because they don't see a path to profitability. They're spending too much money on acquiring both sides of the customer and the taxi driver. So they're spending too much money on that to ever actually turn that into a profitable business. It'll be interesting if they ever do, but in their own statement, they said they might never be a profitable business. So understand your metrics for your specific business and know your numbers. Because me as a venture capitalist, if you don't know them, I'm not going to help you and I'm not going to invest in you. So this is an important point. So what we want is an investor. We get in our email server every morning, we get maybe, a few business plans. And that's not the way. If you want to get to Clive, that's not the way to get to Clive. If you want to get to any sophisticated professional investor, that's not the way you get to them. You need a soft introduction. Find someone that knows me, that trusts you, that introduces you to me, and I will probably see you. More than likely, I would at least respond to you, and I'll probably see you. We want people, venture capitalists don't want to get to know you. They want to be introduced to you. We want to get an introduction from, if Fred comes to me now and says, Clive, I saw a great business, I will absolutely take the time out to go and see that business. So if you want to get to a venture capitalist, the relationships and the network is absolutely critical. But the point I make there, the second point I make there is we invest in lines, we don't invest in dots. And let me explain to you what I mean by that. Sorry, I'm running out of time, but just quickly. So there's a nice saying in the venture capital community, and this is from me working all around the world in venture capital, is that If you want to raise money, go and ask for advice. If you want to get advice, go and ask for money. That's what happens in the venture capital community. So if you want to raise capital from Clive, phone me and say, look, yeah, I've just started my business. It's early stage. It looks really exciting. I'm not asking for venture capital. I know I'm too early. And I meet with you and you say, I've just got one client now. I'm doing, 100,000 Rand a month. Fantastic. But you say to me, in 2 months' time, I'm going to be doing 300,000 Rand a month, and I'd love to meet with you. I say, well, great, let's meet in 2 months' time. But you come back to me in 2 months' time, and you're doing 400,000 Rand a month. So you've now created 2 dots, and then the next dot, and the next dot. So I see that line is starting to do this. It's going northeast. And when that line is going northeast, I'm saying, wow, this person is over-delivered on every single metric. I'm investing in this business. So remember, we invest in lines, not dots. So don't expect a one, meet you, and I'm going to get your capital. It doesn't work that way. Go and rob a bank, it's easier. Don't do it to a venture capitalist. No, I'm only joking. Don't do it. Hey, Discovery's got a bank. Sorry, I better not say that, yeah. That is dangerous. Very, very importantly, is put yourself in your investor's shoes. And Paulo said it as well, that get to know your investor, because not every investor is for you. You might just have completely different cultures. You might have the strategies are different. I might invest in disruptive tech, and you got a manufacturing business. There's no match with the two of us. So there's no point in coming to me. You got a manufacturing business. You might have the best Kool-Aid in the world, but I'm not in the Kool-Aid business. I'm in the tech business. So you need to understand the investor's business model. So my business model to all of you now is, if I invest $1 million in you, which is about the average check size we write, I want $10 million back in 5 years. So I want 10 times the money back in 5 years, okay? So if I use what I learned in Silicon Valley, I use a baseball analogy of 2-6-2. So I make 10 investments, I get 2 home runs, and I get 100 times my money. I put $1 million, I get 100 million back. 6 of them I get to second base, third base, or fourth base, so I get a little bit of my money back, and 2 of them are blowouts. I lose all my money. And that's why we look at it as venture capital companies. All we need to do is get those 2 home runs, and we will pay back our fund, and we'll pay back and have a very, very successful fund. So you need to understand, unless you can show me that you're a 10x business, that you need a certain size market. So what are the things I look for quickly? I call it the 5 T's. Now write this down if you've got a pen, or put it on your iPad or whatever. Number 1, team. Okay, there's only 1, it's not 5, just 1. Number 2 is the technology. You've got to have a very disruptive technology. You can't have a me too technology. Just like Paulo says, we see this, someone says, sign an NDA to me. I say, I don't sign NDAs, non-disclosure agreements. Why don't you sign them, Clive? Because I see the same business. They said, no, we're exclusive. You could never see another business. So we don't sign NDAs. But the next day we see the same business, and the next day, and the next day, and the next day, and the next 15 years we see exactly the same business from every single entrepreneur. So you might think you're unique, but you're not. Okay? So the point I'm making there is, you've got to understand. So best team, most disruptive technology that's got a 12 to 18 month moat around the castle. So it's got, what I mean by the moat there, it's a defensible solution. So if everyone starts copying you as you start making money, you're 12 to 18 months ahead in terms of innovation. And they can't just copy you because you'll out-innovate them every single time. The third T is a target addressable market. It's got to be a large target addressable market. It's got to be something that I always say, build your business where you birth it. So if you birth your business in South Africa, build it here initially. Get enough traction, and then you can worry about you doing 10 million a month or 5 million a month, then worry about taking it all over the world. But it's got to be a large target addressable market. Large in South Africa, large in Africa, large globally. That's the third T. The fourth T is traction. I've said it to you already. You want my money? I want to see traction. I want to see the dogs eating the dog food, just to use that metaphor. And the fifth T is terms. So we've got to have reasonable terms. You can't just have an early stage business doing $500,000 a month and you're valuing this thing at 4,000 trillion gazillion rand, which I see every second day as well. I mean, it's unbelievable. I say, well, where did you get that number from? No, I was in Silicon Valley last week. I'll say, well, get back on the plane and go back to Silicon Valley and go and raise the capital from them. Because we talk rands, we don't talk dollars here. So understand put yourself in your investor's shoes. Understand my business model. Understand what I invest in. Understand what makes us successful. And then we can help you make you successful. Last but not least, not all money is the same. Now, this is very important, guys. The few of you there, or the people out here that's going to have great businesses one day, what is a true venture capitalist should be giving you? Not capital. Capital is the least important part of what a professional investor should give you. Number 1 is mentorship capital. Okay? Now, Paul also spoke about this. I want to see that people are coachable. They have to be coachable. So I want to provide them, in my team, I've got a board of over 200 years experience, we can provide that mentorship capital. Next one is relationship capital, social capital. So we can network, we can open up Discovery. I can contact someone from Discovery and open up the door for you. And I can contact someone from Standard Bank and all over South Africa, and I can do that from anywhere in the world to open doors for our investee companies to our relationships. And the next one is social capital. So that's actually, or human capital is actually about finding the best talent that we can attract to your company, because we're very connected and networked in the environment. So just to conclude on my bonus lesson, that's money going down the drain. You can hear that whoosh sound. It's just money being, make your forecast realistic. There's a great sample, and I'm going to end up now. So sorry, Fred, but I'm going to end up now. There was a company in America I think when the internet just got going, about the early 2000s. It was called Pets.com. I don't know if any of you have heard of Pets.com. So it was this company that went out, raised, I think, $400-500 million of capital, and they were going to be the number one dog food company in America. And let me tell you how their pitch to investors went, which actually worked. Okay? So their pitch to investors said, there's 300 million people in America, 25% of those people have a dog, own dogs, so that's 75 million. Each of them own on average 2 dogs, so that's 150 million. And they eat 2 cans of dog food a day, so that's 300 million cans of dog food every single day. If I just get 1% of that market, I sell 3 million cans of dog food every single day. I sell it for $2, I make $1 profit, I make $1 billion revenue every year, and $500 million of profit. That was their forecast. They were actually liquidated 4 or 5 months later. $400 million, $5 million down the drain. Every single thing liquidated and gone. What you need to do for your forecast, do them bottom up, not top down like that. Like, I've got toothbrushes, I want to sell it to Chinese, I'm going to sell to 1% of the Chinese market, that's 1.5 billion people, so I'm going to sell 1,550 million. Boom, boom, boom. Crap. Doesn't work that way. Doesn't work that way. Do a bottom-up estimate. I'm going to sell to these clients, this. That's what we're going to do. That's what we're going to make. That's the type of subscription revenue we're going to get. So make those forecasts realistic. Please, there's nothing more irritating as a venture capitalist to see these gazillion rand in 3 weeks after forming the company. It just doesn't work. So are you ready to raise outside capital?
Yes.
Great stuff. Thank you.